The Indian startup ecosystem is not as mature vis-a-vis other advanced economies. Very few investors have completed the learning curve of angel investing and received an exit. The ones who have experienced it better and have led the others are generally termed as lead investor in our parlance. We would love to get into the details of revealing the so-called beast, lead investor. Who is a lead investor? What does he do? Is it a full-time job? What are the skills required? Don't get rattled. We have the two most sought after leads with us to take you through to it. For the first time at LetsIgnite, we bring to you the Lead Investor Masterclass. Please welcome William Bao Bean, General Partner, SOSV, the Accelerator VC, which is the fifth most active angel and seed stage investor in the world for 2018, with $550 million under management. At SOSV, William is the Managing Director of China Accelerator, the first accelerator to launch in Asia and the only accelerator in Asia to have a unicorn through its program, BitMEX. He is also the founder and managing director of MOX, the mobile-only accelerator, providing startups with free user acquisition. Sunil Kalra, active angel investor and listed among the topmost investors to raise funds from. Sunil aims to help entrepreneurs scale, build, reckon the market, and grow successful at everything they do. He believes in working closely with founders and provides his expertise, experience, insight, and inspiration. We also have Manuel Jose, partner at Sagar Associates. Please welcome them.
Start? Sure. So thanks for having us. Really appreciate it. I mean, it's a relatively small group, small room. So we're going to talk for a bit and then hopefully do some Q&A. And we're going to basically trade off here and moderate each other, I think, a little bit. So maybe we'll just kick off slides and I'll have some comments and you can start off.
It may be fun to get to know the room a little bit.
Yeah, that'd be great.
So can we just have a show of hands of how many of you have invested in early stage companies before? Wow. And let's say more than 5 or 10? Good. And how many of you are from a technology background? And so is that your primary focus of investment is tech companies, or are you looking at, yeah? Okay, great. So we've been introduced, we've been flattered, at least I have, I really don't have any special skills. I've just been doing this for a long time. I started to do it after I sold a company and had nothing to do. I thought I would be retired and I thought I would be happy, but 6 months into it, I was itchy again and needed to do something, but didn't have the courage to start my own company. And so I started to look out for people that I could invest in, and that worked out pretty well for me. I think I invested in large checks in a couple of companies and saw some very sweet exits. But the lesson I learned is the lesson that we're going to speak about. It takes 10 to 15 years. So if you're not patient, those exits aren't coming, right? With the exits and with the support of, one of the things that I helped to found was the University of Petroleum and Energy Studies in Dehradun, which was started from scratch. I remember going to see many sites, buying land, building the building, sitting there and working with the architects, and then building a beautiful, beautiful university, which we successfully exited to the world's largest education fund. I had tears in my eyes when we left, because on a board of 7, I was the only one that didn't want to sell, right? But sometimes you have to sell, so we'll also try to cover when to sell, and why you have to sell, right? Manuel comes from Jyoti Sagar, which is one of the leading law firms in the country. He's got immense experience. I think some of the things we'll talk about may include legal issues that we should all be aware of. We're trying to build a really robust ecosystem. I know I'm boring you with this, but the simple thesis that I have is that I'm comparing us to Israel, which is a country I've been investing in for the last several years. I have a portfolio of 15 or 16 companies there. 7.5 million people, 1,500 funded startups every year, $5 billion worth of venture capital entering the country every year, and $10 billion worth of exits. That's pretty wow, right? And in India, with a country of 1.3 billion, we still don't have 1,500 funded startups. And I have been, a part of what I do is because I think that's not right. There's so much we need to do. There's so much nation building that can happen out of investing. And, you know, here we are, right?
Yeah, so I'm just going to give a small case study on myself, and hopefully that can inform a little bit. So, yeah, startups is an asset class. It outperforms, but you have to look at it as an asset class, not like gambling. So in order to treat it like an asset class, you actually have to take a portfolio-based approach. You have to invest in more than one company. Actually, you have to invest in more than like 5 companies. You have to. When I started, I mean, I did my first angel investments in '99. But when I read like Angel Investing for Dummies, kind of what we're doing here today. So I didn't follow all the rules, but I followed most of them. And so for 9 years, I did one investment every 3 months, give or take. So 4 a year for 9 years. I did 39 angel investments. And this is even while I was a VC. So I did 2 startups. I was a really, really crappy CEO. But I recognize that I'm a better investor than I was a CEO. Really horrible. But I learned a lot, and so I just wanted to pass that on. Now, it is an asset class. So the idea is that you take a portfolio-based approach, and you want to invest in companies where you think that you can help the company, and then it has to be over time. Okay, so most VCs, they invest in 10 companies, and they're hoping for like one kind of returns the fund 2 or 3x, and the other 7 or 8 die. Maybe they get their cash back on 1 or 2, or maybe 3x. But a 3x for a VC is a failure, right? Because you got 6, 7 are dying. But for angels, you actually have to do a lot more. So for SOSV, we've taken this to a bit of an extreme. Okay, so we invest in 150 companies a year. And we 700 companies every 4 years, so we invest a small amount of money in each company, and then we work with the companies, and then we double down. Then we put more money, and this is what I did. So 39 companies, 4 or 5 I got exits, 2, 3x, whatever, which is actually a loss, but. Over the 8.5 years, 9 years, I put 30% of the capital deployed into 2 companies. So why did I do that? Well, those were the winners. So they took off, and I invested again. And even though the second investment was 6, 7x higher, these companies are going up and to the right. And so you need to double down. So the 30% of the capital was in 2 out of 39, but that drives the return. So cash on cash, I exited one of the 2. Cash on cash, I'm up like 2.5x over 10, 11 years. And then on a paper, the other one's still out there. So on paper, I'm up about 9x. So that's the last part. Be patient, because those companies that I invested in are in 06, 07. Okay, and the first one I exited, we got out about 2 years ago, but the last payment hit my bank account today. Okay, so that's an 06 investment and an 07 follow-on.
So it's champagne after this.
Yeah. Well, I'm paying my kids' tuition with it. And then the second one, I invested in 06. We still haven't exited yet. Took a little bit off the table, but yeah. So. You have to be patient, so you can get outsized returns. Much better than interest, much better than mutual funds. If you do it right, much better than even the S&P 500. which is 16% every year. But you have to actually follow that formula.
William and I met for the first time today, and we had one brief call last week to make sure that we put our thoughts together to be able to entertain you or pretend that we know something. But it's remarkable how aligned we are on our thinking. I'd like to go back to the first slide because I've not had it. So when we look at startups as an asset class, I would go so far as to tell you that please be really careful and very, very disciplined about what you do. I learned this lesson when I was very, very young, and I took a ferry from Dover to Hoek van Holland, and it was a gambling ferry. And I played all night and got off in Holland with no money and 10 days to spend. Right? Luckily, the hotel room had been paid for it, but I'm never going to reveal the details of how I survived that. But but here we are. So you have to be disciplined. I would imagine that anybody that's investing in startups has money to put to risk. It's a really important asset class because we're doing multiple things as we invest in startups. We are building an ecosystem, but don't do yourself wrong by gambling beyond the point. When I write a check to, and sorry, I'm a little distracted here, but the wonderful thing about having William here is that we can get a slightly more institutional perspective on some of the things we talk about. I'm not an institutional guy. I've done more than 120 investments, 130 maybe. I really don't remember the number. I don't have a spreadsheet. My accountants have it, right? Sometimes I forget which companies I'm in, and then I'm talking to somebody and say, oh yeah, I have a company that does that, right? So that does happen when you do a lot, and I travel a lot. So it's hard to keep up, but that's not what it's about. It's about the early days. It's about the days when you make the investment. It's about the time you spend with the company at that stage. It's about why you're doing it. But it's also about making sure that if you have 100 rupees to invest, you take 10 or you take 15 or you take 20 and in a disciplined manner, invest that much every year. So please be very disciplined and please be very patient, because I have really not seen any environment where it takes less than 10 to 15 years to build a company. And so if you're in it for those really large returns, and I do have some unicorns in my portfolio, I have hopefully 3 or 4 companies that'll list next year, which is so exciting. It's just, it's a reason to live because you'll get something back, hopefully. But some of them were invested at a long, long time ago. But look at it. So I invested in a company at a 5 million pre, and it's worth over $1 billion today. I did invest in, something else at India-facing company at the seed round at a 10 rupee face value of share, and it will list next year for maybe 400. Which is not a bad return. It's again 7, 8 years, 10 years, right? So these things do happen, but you have to be patient. It doesn't happen with all. There are so many that have died, and so many. One thing I've learned is that if a company is not doing well, and I had this experience just last week, there's a company in the US that was doing something spectacular, but they couldn't make it. And the founder reached out to me and said, look, I'm really having trouble with the investors and I don't know what to tell them. And, I just sat with him and said, look, you got to shut it down because you have a family. You owe something to them. You owe something to yourself. You've done it for 7 years. It hasn't worked. It's time to call it a day and do something else. Get on with your life. So there will be failures and you must be able to accept those. Please don't expect every single company to give you those kind of returns that we've been lucky to do. Again, I perhaps started doing it at the right time. But the wonderful thing is today, the time is even better than when we started. Yes, there were less people doing it. There were, at Indian Angel Network, and there were hardly 35 members when I started to invest, right, with them. But I had already started investing even before that, right? So it was a golden time because all the deals came to us. And today there's so much more competition. There are so many more of us. There are so many VCs. There are so many different sources of capital. Even the banks are getting into the game. Luckily, the banks are now starting to invest through homegrown funds, which are also going to be, India capital is going to be a very big story going forward. So I think it's a really good time. Also, I'm seeing very mature entrepreneurs begin their journey. And people that have actually built companies before, or exits from large companies like Flipkart, like Make My Trip, like Paytm, like, people that have been working there for 3, 4, 5 years, their equity has vested. They want to get out and do something of their own. Those are great entrepreneurs. Those are really entrepreneurs to watch out for, because they're sitting there and they're coming to build a company because they know that they didn't have the ability to do what they wanted within the company that they worked in, and they're seeing failure points. So they want to change things, and they want to do things better. And those people, I feel, are very driven and very backable. So again, we should look at some stage during this conversation is how to identify a company to invest in. So it's high risk, portfolio-based approach. I have 130. I can only speak about 4 or 5 or 10 winners out of it. Yes, some are going to return money, some will return capital, some will get acquired, some will give me 50 cents to $1. That's all fine. It's all part of the game. The numbers add up. My portfolio also would be up 6, 7 times. That's a healthy return. It's a good return. Your knowledge and your network, I think we'll talk a lot about that. Because when you start to invest, if you don't go in with a helpful attitude, and if you're not really empathetic towards the startup, and you don't really take them into your fold and adopt them and spend the time with them, you'll never have a good relationship, good enough relationship, which is defendable later on, and we will cover that. So that's it. Manuel, anything that you'd like to add on this, or this is still basic?
Okay.
All yours, William.
Okay, so if you're just portfolio management style, old school, usually people say don't put more than 15% of your net worth into super high risk, which is what this is. Some people say 20, whatever, 25 or more is crazy. Don't do what I did. 100% of my net worth I put into Angel. And then, yeah. Yeah, I got just don't, yeah. Do as I say, not as I do sometimes. Okay. And then the other thing that's very, very important is start small. So if you have 100 rupees and you decided to put 20 on gambling, which is if you do this wrong, which is what it is. So the general idea is that you're in a 10 to 15 year, 12-year cycle, let's call it, right? So you need to think about how much money you're going to have over a 12-year period. And then you're investing half of that with the first check, give or take, and then you're reserving the other half for the double down. Okay, it basically without the double down, the whole model does not work. Our entire fund. And we're unique as a fund, SOSV, in that we were started as a family office for our founder, Sean O'Sullivan, SOSV. And so we could innovate in early stage. And we scaled this up. And so, yes, we invest in a lot of companies. The key thing is the double down, because you're getting 1-2% or a small piece of a pie. Well, most late-stage startups, when they exit, the founders are down to like 10, 15, sometimes 5% of the company if they're lucky. But you start off with like 2% or 3% or 1%, and you end up with 0.2% if you don't double down. Okay? So it doesn't matter how big the exit is, 0.2% after waiting 12 years is not going to return very much. So look at your first check as tuition. This is my view. and your second check is a smart money bet. Okay, so I had 39 investments. 30% of the capital deployed was in 2, and that was because I doubled down. The other thing is a lot of people get really excited in the beginning, and they start off with big checks, and they end up with small checks. I did that. And it just so happens that the 2 companies where I did in the beginning, and they were the big checks, so I got a little bit lucky. But if they weren't, then I would have my returns would have been much, much lower. So actually do the math, chart out the next decade, and make sure your check is small enough so that you have enough dry powder to double down when it's time. I'll let you do 2, but in terms of, unicorns are mythical animals that do not exist, okay? We are...
They do in the toy store.
Yes, that's where we buy them and we give them to small children, okay? Okay, so there's lots of talking ones from China. I live in Shanghai. So I think think about... sort of just math. There's a lot of reports out there, but how many $20 million exits are there? How many $50 million exits are there? How many $100 million exits are there? And how many billion-plus exits are there? And how much do the founders own of those billion-dollar exits? And actually, in terms of time and return, a $20 or a $50 million exit is actually much better, not only for the entrepreneur, but sometimes for the angels, than the billion-dollar exit. Okay, there's a lot more of them, they happen. So even if you we're getting a unicorn every 300 investments, which is actually almost double the average. But I think it's like one unicorn every 470 companies or whatever that raises a seed round. Okay, it's pretty low percentage of happening. So we're doing a bit better than that. But even if you take the unicorns out, as a fund, we're still returning, probably returning 3-4x on the fund. And then I already talked about double down, double down, double down. Just binary outcomes when you're in their early stage, it's a 0 or a 1, okay? So you're in it with the entrepreneur. You're not a VC. If things go badly, you're probably going to lose all your money, okay? And don't cry about it. It's just part of it. If things go well, if it's a 1, it'll go up and to the right, and off you go, and then you double down on those. But the valuation, the terms, in the early stage, we actually recommend not putting all the bells and whistles, not putting all the rights, not putting all the protections in there, because they don't matter. Because you're at the bottom of the stack. You're the first money in on top of the entrepreneur, and you've basically got common stock. And so what you want to be is you want to protect the entrepreneur from the VCs. You're on the entrepreneur side. You are not an investor side. And so, and for most of these companies, really, it's either going to go up or dead. Because if you ever see a company that gets a Series C, Series D, Series E, they're going to give more ESOP to the founders. And there's so many preferences ahead of you that there's a very good chance you'll get 0 even if they do have a $500 million exit.
Yeah, absolutely. Again, I just have to agree completely, and we're going to bring in Manuel on this, on a couple of points here. I always start small now. When I write my first check, it's done. I forget about it. I never expect that money to come back, right? So unconditional love is something we all seek. And the only living beings I've ever gotten it from is my dogs, They give me unconditional love. They're always happy to see me when I go home. And, will a startup give you back money? We don't know it, right? So when you write the first check, write a small check, help them to seed the company, and think of it as something you've given away. Have no expectations. When it starts to grow, make sure you have enough to double down, right? And so there are really, and this is, guys, I cannot emphasize this point enough. because I do have that billion-dollar company that I'm going to make very little on, and I invested at very, very early stage, right? I'm just going to get, because I got diluted. You're not protected from anti-dilution, right? So when should you exit? That's again something we're going to cover a little later, but you need to be smart about what you're doing. So I put in a small amount in the first check, but I reserve the absolute right to be able to invest in subsequent rounds. Most VCs will try to discourage you from doing that, from exercising that right. There, your relationship with the entrepreneur helps you a lot. So if you've given from your heart and then spent the time and nurtured and done all of that, they will want you to remain with them. Because if they think of you as a part of them and they know the value you add in being able to protect them, they're going to be much closer to you. So I like to keep good relationships. Of course, there are founders that I tell them, I'm going to block you. I never want to see you again. And, if you come in front of me, I'll shoot you. I have told people that. So, you're building businesses. Unicorns don't exist. Double down, binary outcomes. So, Manuel, how do investors protect those rights? How do I get the ability to put in more money into the next round, which is what we need to do?
So, hi. My role is very limited in this because it's essentially William and Sunil here. So, like Sunil said, we've had this. I've met Sunil for the first time today. I had this discussion earlier with Sunil, and it's always on how much control do you take as a lead investor, how much do you take as a angel. So, that is something which I don't know. Maybe me and Sunil wouldn't agree completely on, but I think all the discussions that we've had, we need to mature as an investment community, because in India the investor community is not, I would say, is not very mature. It is like at every stage they take a lot of control more than necessary. I think that actually now after a discussion I do agree with you. We need to tone down a little of the control that we take. But having said that, how do you protect yourself? Because the next round, you would need a right to invest in the next round. One of the best ways is, you can't capture everything in the document. It is, even though I'm a lawyer, it is not like I would expect everything to be captured in the document. The relationship matters a lot. You would need to convince the founder that you are on the founder's side, because you are supposed to be more of a mentor to the founder than an investor. So if the founder starts treating you as, or the promoters start treating you as an investor, it doesn't work. But having said that, for your first round liquidity, so that you're not diluted completely, one thing like William pointed out, you get common stock initially. Most of the times you would get common stock. It's not like a complex instrument you would get in the initial stages. It's not like you'll get a preference share which would convert at a rate or whatever, because most of the angels would get equity. Yeah, and even in the next round when the investor comes in, he is not going to get equity at the same level as you would. So that initial protection you would have right away. But I guess it is always getting the right balance on how much do you take so that you don't get diluted, but how much, you should leave sufficient left on the table for the next investor. But on top of that, anyway, you will have your standard rights to invest in the next round. And next round comes up, you would have proportional right to invest. So maybe like Sunil said, in the VC would discourage you from investing, but that doesn't mean you should not invest, because there's no way you're going to average out your investment. The initial investment is testing the market. The next round is when you actually do get some more stake in it. So you will have to ensure that is done. And since you're since you're already an equity holder in the company, shares have to be offered to you in proportion to your holding. So it is like, how much would you take as a normal VC? As a normal angel, you would.
Yeah. So whoa. So we take this one you have to hold up, and this one you have to hold down. Okay. So we for our cash we put in like 120K. Now some of that is cash, some of that is service for our accelerator, and we give the accelerator program. And because of the companies that we work with are a little bit later stage, they generally have revenue. They already raised an angel round. We're sort of this intermediate round between the angel or seed and the pre-A series seed. We're usually taking about we need to have about 5%, and we're putting in our program plus around it's 120K, 75 cash, 45 service. So it's something like that. So we're kind of, and we do give like $600,000 worth of perks, most of which nobody will ever use, except for the 100,000 free Amazon and Microsoft Azure and whatever credits. But yeah.
Well, what about you, Sunil?
No, so I work it slightly differently. So the sweet spot for me is rounds which are, I have participated in first rounds which are valued at $5 million and the company's raising $1 million. My check has not been $1 million. But typically, the way I invest is 25, 50, and 100. So I would like on the first check to put in 25 lakhs or 50 lakhs. And I'd look for companies that want to raise 2 to 3 crores. And then I have the ability to call the right people to try to bring them into my round. I don't do syndicates. I don't take any carry or any fee from people, but we are going to talk about that. I think that there is a time. So I just bring in people within my network that I know will be able to help that company. And it's always a different set of people. So the diversity of my portfolio is incredible. I have, fintech companies, I've got healthcare companies, I've got consumer companies, I've got, a company that's doing sanitary pads, I've got, it's just fast. So you have to have a great network to be able to bring in the right kind of people that can help this company and also, give it the time that it needs. So we try to look at it backwards and see, I think it's important to understand what the first check is meant to do. The first check is not going to make the entrepreneurs rich. The first check will perhaps give them sustenance if they need it, right? I normally counsel founders not even to bother doing a company if they cannot sustain their lifestyle for 3 years. If they don't have enough savings to do that, they shouldn't take the leap, especially if they are mature founders, because things are going to get tougher, right? So they might get some sustenance, but really they have to prove their concept. And one has to sit down and understand what that's going to cost. There's, in some cases, in consumer companies, we have to look at branding, we have to look at packaging, we have to look at all of those issues. In internet companies, we have to look at the customer acquisition costs, which is what kills most people. What are the channels? We certainly have to be in touch with Amazon and Microsoft and all these guys to try to get as many freebies for, so if I call people in Amazon, they will give free credits to there is they like to engage. But they're also competing. So recently I got a call from Amazon and they were like, this company we hear is doing well, but they've stopped spending money. And those guys are so smart. They moved everything to Google because Google gave them more credits, free credits. And, they were like, yeah, we're going to do it. So we look at how little it takes, and then we look at a fair value, right? Depending on how much work has to be done. But it's never more than 15 to 20% of the round. It's important to have over 10%, ideally 15 to 20%, because you're going to get so badly diluted in the next round if the company succeeds, unless you have a significant stake. So I don't write the check myself. It's a 25 lakh check or a 50 lakh check, sometimes even a 10 lakh check, depending on what the company is doing and how much I understand of the business. And then I try to work at how much money they need. And then it's really about a negotiation with them, and the founders have to feel good. If the founders are not happy to take your money, don't give it to them. Just don't give it to them. Wait. find the next deal. There are many, many deals in the market. You don't have to do every deal, right? So you got to feel really good about what you're doing, and they have to feel good about working with you, right? So that's my perspective on it.
No, that's exactly the number I was looking at, because I think that's a perspective between two geographies. Because in an Indian perspective, that's the number I generally see. We see about 15 to 20%. Because that works, because in the next round, you would get a pro rata on the same percentage. And so that is a percentage that works, because I don't know, in your investments, 5% in India is a little too low, I guess.
5% of the company.
Yeah.
Yeah, yeah.
So,
It will not work. It'll never work.
Taking 5% of the company is too low. Yeah, because you get dilution. But for us, you got to remember that. So the next check will keep the 5%. We're doubling down, right? We usually give up somewhere around sometimes A or B. So we've got a company doing a B. They're raising 20 on a 180 pre. And I think we're putting 50K in just so we can see the docs. Oh, no, 100. Because 50 is just, sometimes it gets a little embarrassing. But, yeah. But even if they try and embarrass you out of following on, you just got to push back and say, this is my right. I want to, support you. And what's going to allow you to do that? Well, if you're the first call from the entrepreneur, whenever somebody sends them some piece of documentation that's trying to screw them, and you're the first call, and it's like, is this guy screwing me? Is this VC sending me a load of crap? And you come back and you spend the time and you show him or her every single line where that VC is trying to screw them, then you're in a position to protect not only the entrepreneur, but also your position, okay? So you want to, it takes a lot of time, there's a lot of trust, but you want to be that call, or you and your syndicate of friends or group of friends, somebody in that group needs to be the call, or else, the VC, VC's jobs are to screw everybody, except for maybe the entrepreneur. Okay, so, and then the next VC after that person screws that VC, and the next VC after that screws that VC, and you're on the bottom of the stack. You're that crusty stuff on the bottom of the pot. So you got to protect yourself.
Yeah, but there's a very interesting situation that has emerged recently for me, where I invested in a company, and I'm really hopeful about this company, and I tell the founder always that he's my retirement plan, and he better keep doing well. So yes, this company was at a very early stage when I met them. They were doing about 18 lakhs a month in revenue already. They had set it up, and the investor, the founder, had put in his own money. And that is always a good signal to me. I love it when a founder has actually invested some of his own money into the company. It's a great sign. They believe in themselves, right? Of course, this guy is a mature founder. He had worked for 10 years before, and he was looking for the right set of investors. He grew very, very rapidly and scaled to, 50 lakhs or 80 lakhs a month when institutional money started to chase him. Before that, they wouldn't talk to him. And when it became 80 lakhs a month, somebody came and wrote a nice $5-7 million check, and that's resulted in more growth. Of course, I was able to participate in that next round, and for the first time in my life, I'd been clever and insisted upon a 20% discount to the next round, which I normally don't do, but I did it in this case, and so I was able to actually get in on a discount. But there were good reasons why the founder agreed to let me have those rights. And then now the company is reaching a run rate of, hopefully by the end of the year, of 450, 500 crores. And they've got a great margin, and now the whole world is chasing them. And people are starting to give them checks and saying, please take $3 million from me in a convertible and whatever. So the founder called me up and said, look, there's so much interest, and I want you to remain. Why don't you participate in this round? I said, look, it's too expensive. I mean, this company is now going to be valued at 100 million plus, and where am I going to come up with the money? He said, look, you've got pari passu rights. Set up a small special purpose vehicle, and put in what you can. And some of the people that want to come in, I can route them through your vehicle because you have the rights. Or you bring your own friends in, and that becomes a great opportunity. So there are people who are offering me a carry on that investment. Again, it's not something I do by nature, and it's really an individual decision. But there is an emerging model of a lead investor being able to charge or take a carry from people. I know that, Let's Venture encourages it, Indian Angel Network encourages it, Angel List encourages it. But if you do take money from fellow investors as a success fee or whatever, then you better deliver. And then you better be able to go line by line through every single, because remember, there are more failures than there are successes. And those guys will come at you with bats and bricks and stones and all kinds of stuff if you take money from them, and then the company doesn't deliver. So you got to be careful on that, right?
No, I mean, I helped run an angel group, and I led a bunch of deals, and they had a carry structure. And it's okay, yeah, you do the work and you get the carry. But I don't know, I think I got one, a couple companies maybe return cash, and then I've got 2 companies doing well out of something like 14. So yeah, you're the lead. You got a giant target on your back, so you better not have oversold the thing when you started. You got to be truthful with your friends because or your neighbors or your syndicate. You got to go in and put in the positives, but also put in the risks, because you're going to assume that most of these companies are going to die. And who you're going to blame? You can blame the startup, but you're also lumped in there as the person who was the conductor or drove. Yeah, the Pied Piper driving everybody. Or what are those little birds that fall off the cliff? Yeah, okay, yeah, that's you leading everybody right off the cliff.
So the difference between angel, the startup world, and the equity markets is that when everybody wants to get in, it's the time to get out in public markets mostly. But here's a situation where when everyone wants to get in, you better find a way to stay in for as long as you can, because there's a good reason. I mean, venture capital is very smart capital. They're very, very smart capital, right? And they only make money, they use other people's money to invest, and they only make money if they succeed. So their model clearly is carry. We shouldn't get that confused. Again, it's an individual decision if you want to take a carry and the responsibility. But there will be emerging situations where you might be able to invest going forward using other people's money.
No, I think we're skipping around.
Can we do that though? Which one? Set up an SPV to be able to invest into using your rights. Can we do that legally?
Yeah, I mean,
If somebody's interested.
you can set up an SPV so long as the rights are assignable, because you'll have to ensure that in the contract right in the beginning you say that the right is either directly enforceable by you or
assignable.
It's assignable. So long as you have that written in, it's fine. So the advantage with what Sunil mentioned is, if you have an SPV, it'll be it's actually, I would say, the VCs find it easier because they have to deal only with one company. So like if you have a syndicate, because those are different individuals putting in money, it's like a VC is not comfortable because they're like, I'll have to deal with another 4 people. Even though there's a lead investor, the lead investor might have the decision-making powers. The others are still shareholders. So there are inherent shareholder rights which they will have. So an SPV model is a way to avoid that. But I'm not sure whether tax-wise it might be a good idea. That is something you'll have a problem with, because
It's fairly tax efficient, I think.
because the money that
It's a pass-through.
pass-through, but you'll have to dividend it out of the next company. You would have paid tax here and there.
Correct.
So tax-wise, it might not be the most efficient unless you use a debenture structure or something in the second company, so that, you can structure. Everything can be structured. there's
Yeah,
nothing
but
about it.
the fact is, guys, if you're willing to invest your money at risk, then you also please invest in good legal help and good accounting help. You do need those resources. You cannot do this without that help.
Yeah, so one of the things that we recommend is, you always have a group of friends or a syndicate or some angels that you invest in or whatever. But, after you've done, I don't know, yeah, sure. So say you've done 5 or 10 investments, like all of you have, almost all of you have, okay? And hopefully you've got like 1 or 2 that are good. I don't know about India, but generally what we do is we say, okay, we are lead generation for the accounting firm. We are lead generation for the law firm. Okay, so not all the companies are going to do well, but say 1 out of 10, 1 out of 20 should do well. So usually what we do is we get, discounts. We get discounts on the early stage, with the thought that over time, the lawyer will flip from being our lawyer to the company's lawyer. Now, of course, once the lawyer, who's our friend, becomes the company's lawyer, the lawyer will be protecting the company. But since we're such great friends with the entrepreneur, okay, the entrepreneur's interests are pretty close to our interests, and usually we have common stock, especially in India. But also, the lawyer is your friend, and he's not going to chuck you under the bus usually. So then you have us plus the entrepreneur, plus our mutual friend, the lawyer that's representing the company, so that when the VC comes in, hopefully there's like a kind of a united front. And what does the lawyer get? Well, the lawyer spends time and probably loses money on like 4 or 5 or 6 or 8 companies, but then they get a client, and this client hopefully ends up being, a winner. And that's when the fees, lawyers, they might serve a lot of companies, but if they get a big one, who starts doing 10 million this and 20 million US that and 100 million US that makes their whole life. He's sick of working in a big firm, and he did in-house counsel for a while and took a company public, and he wanted to go independent. So I had some later stage deals where I got him paid so he wouldn't starve to death. And then he had my back on the early stage stuff, and he basically did it for free. And then now he's got 5 lawyers underneath him, a San Francisco office and a Shanghai office. And he got to get out of China and move back to San Francisco, so he's happy because China's Shanghai's a little bit like, I don't know, Delhi today, polluted and hot, right? So so you want to build a series of partnerships. It's called like a mini ecosystem. And that can be really helpful, especially when the big guys come in and try to mess with you.
Guys, we're already 1 hour into this. Is anybody getting anything out of it? Should we stop now, or should we go? Anybody?
Anybody have any questions? You got a question?
Yeah.
Yeah, just yell. It's okay.
This is the mic that I hold. Makes sound? Oh, okay. Thanks a lot. I mean, you guys are giving a lot of insight here. I just wanted to know, which would you look at as an approach? A spray and pray approach of doing 100 or 150 startups over a period of time, or having an investment thesis and say, I want to invest in these sectors and these type of companies?
Okay, so we're probably going to differ. Well, differ somewhat. So I don't necessarily think that you need to have a thesis. But the way I try to explain it to some of the startups I work with is that VCs are a little bit like fish. They got the brain smaller than a pea, and the attention span that lasts about 3 seconds, and they move together in schools. Okay, so if you've got your worm on a hook, and you're the fisherman, i.e., the startup, do you want to put your fishing pole and your hook with your worm in the part of the pond where the fish are, or the fish are not? Okay, so actually, for early stage, you don't want to put your hook with your worm right in the middle of the school of fish, because they'll just eat the worm and then you don't get anything. But what you want to do is you want to stick the fish with the worm where the school is heading, get there a little bit of it ahead of them, and then they'll hopefully come in, and then you can bag a fish, right? So it's kind of a weird analogy, but so we don't generally focus on a thesis, so to speak, but we look at where there are problems that or challenges that need to be solved, and then we try, and this is the hardest part, to figure out whether this challenge can be solved within our time frame, within the next couple of years type of thing, 2 to 3 years. Is this a now problem, or is this a slightly future problem? And if you're in the market, you know what the problems are, you know what the challenges are, and then when you bump into a company that can potentially solve the challenge, and they've got the right team to solve the challenge, then you hop on that. And so, is that a thesis? Kind of, but it's not like, oh, let's go blockchain, or let's go AI, or let's go online to offline. It's more. It's more of an approach. So yes, what we do looks like spray and pray because we're investing in 150 companies a year. But when you break it down, we have 6 accelerators in a lab. We're investing in no more than 15 companies per batch. Each batch is like 6 months long. I'm more like 8 to 12 companies per batch. So we're not a puppy farm like YC. And so we spend a huge amount of time with these companies for a 6-month period of time, and then hopefully we hand them on to awesome other investors. So it looks like spray and pray, but we have a systematic, data-driven, process-based approach to early-stage investing. And I'll give you some numbers. So TechCrunch numbers of the top. So you look at companies, startups that raise 100K. And this is TechCrunch Crunchbase. So it's not great data, but it's data. So how many 100K companies that raise 100K hit a valuation of $100 million? So it's like 1 in 250. And so another statistic, I think it's from CB Insights, is how many companies who close a seed round, which is usually a lot more than 100K, say 500K, hit is it unicorn? I think it's like 320 something, 1 in 320. So what you're trying to do here is really, really quite difficult, unless you take a number of shots. Okay. So the more shots, the better. That's why I say small checks, lots of shots.
No, great. So,
you spoke about 10 in a batch stays for 6 months. You also spoke about 150 in a year.
Yeah. So we have 6 accelerators and a lab, each of them doing 2 batches a year, each of 8 to 15 companies. And if you add it up, it gets somewhere around 150 companies a year.
Is it practically possible to spend time with 150 companies in a year and still do good justice to them?
Well, we don't spend that much time with them all in a year. We spend that much time with them all in a half year. So we do 2 batches a year. So we do weekly board meetings for 6 months with the 10 companies or 12 companies or whatever it is. So we're very, very, very focused on them for a shorter period of time, and then we hand them off to our trusted partners. We don't take board seats. So we're in a very sort of special spot. And so we spend a huge amount of time, but for a short period of time.
Who would be the trusted partner to you?
So usually they're other VCs, angel groups, angel funds, but usually for us, these companies are going off and raising 1 to 3 million, or sometimes a 5 million A, or 3 million A, or whatever you want to call it. So there's usually they're like early stage VCs. Companies, people raising, writing 300K checks or 500K checks or something like that, and they are taking a board seat sometimes. No. 6 months to 18 months later.
So also to answer your question back there, I would like to call it a portfolio approach more than spray and pray, because the first question I ask people when I meet them is, why are you doing this? And they need to convince me about why they're doing it, right? And then if I can understand the problem, and I can see that this is a big problem that needs to get solved, and it will have a positive impact. To me, that's very important when I invest in companies, especially now. I'm one of those guys that believes that technology can solve the biggest problems of the world. There's a special group of people at MIT working on solving some of the largest problems in the world. So I believe that, the key issues, roti kapra makan, as we say in India, your bread, your accommodation, and your clothes can be solved by technology. And that's why I'm investing in it, right? So I need to figure out what is the problem you're trying to solve, why you're trying to solve it, why you're the best team to be able to solve it, why you think you can. And if that resonates, I'm tempted to invest. But I don't do it. So recently there was a wonderful company that I met. Fantastic 4 guys, close friends from IIT Delhi, brilliant guys, really strong. And they are doing something that I believe is solving a very big problem in the gaming. This died. So, but I didn't invest. I spent hours with them. And I really like them. But I don't understand the problem. And so I said, guys, I'm sorry, but can I help you? Can I introduce you to other people that might want to invest? Now, it may happen that somebody takes the lead on that and says, hey, come back into the round and invest. So I'm not hung up about being the lead. I will follow as well, right? And I also invest to protect myself along with a few funds. So I have a co-investment option also with some funds that I work with, right?
Hi.
Yeah.
So, thanks. It's absolutely a fantastic session. I just wanted to ask one question is, so the approach here that, okay, I like the team, but you're not investing. I like you guys. You're not solving a problem, but I know you'll figure it out. And if not, you'll pivot. If this kind of an approach, should it be taken when you're investing in a startup?
You mean, so
So
yeah, so basically, whoa. Okay, so, okay, this is the other one. Anyway, so basically, what you're saying is investing in the team, not the product. So what we generally do is we invest in the problem and the team. We don't necessarily invest in the product because the product's always going to change. But the team has to be super passionate about the problem. We need to believe in the problem. And then we also need to believe that the team is the right team to solve that problem, which is generally why we don't invest in children. Because especially if you're enterprise focused, you need to have some sort of domain knowledge, which you usually don't get in college or even grad school, right? So I don't know whether that answers your question. Okay.
No, but I think what William has said is very, very important, right? So again, and to answer your question, from my perspective, the problem doesn't change. The pivot is more about how to solve the problem. And certainly, I don't know of many companies that have not had to pivot in during their life. I mean, just look at all the companies, right? Even look at Amazon. They started out selling books. And what are they doing today? They pivoted so many times, right? Even before they were profitable. So many examples of companies. Every company, Microsoft, they pivoted. Google pivoted. Everybody's pivoted. So pivots will happen, but they're still solving a problem. And you have to be aware, and I think you should believe that the problem needs to be solved.
Most likely when an entrepreneur decides that he needs to pivot, he'll be most likely out of money. So how can we be so sure that he'll pivot in the same company? And
By spending enough time with them in the early days and helping them to set up some benchmarks. Again, we're getting to that, and to be able to. So one of the things that many, especially the very young founders, they need to learn how to have measurable metrics. And you need to put in the work to do that. We're going to get to that. Why don't we take, is there any more, and then we'll continue with some slides, and then we'll come back to more questions. So is there anybody else that has a question right now? At midpoint?
Regarding the pivot, when would you ideally, what are those parameters which you would speak to the entrepreneur about and say that, now I think is a time to pivot?
Well, if you're using metrics, if you're using OKRs, if you're using any sort of like or one metric that matters or North Star metric or I mean this is really basic stuff that we try and teach, and then we make them read about it and then we try and implement it. So it becomes patently obvious that this shit is not working.
Nah, but you don't tell them you have to pivot. You tell them rethink it. You know.
We don't call it a pivot. We just call it a like, oh, you experiment. Why don't you, try the next thing and try the next thing. And when you're doing 2 or 3 or 5 experiments, usually 5 is a little crazy, but say you're doing 2 or 3 experiments a week, it's not a pivot. It's just next week. So for us, we spend time with the founders, but our diligence is living together for 6 months. It's VCs oftentimes date, and then bang, they get married. Maybe this is the wrong environment for this analogy, but so we date, and then we put down $100,000 engagement present, and then we move in together for 6 months, and then we get married to the top third.
Yeah, they're lucky. You know, it's nice when you have $150 million to spend every year.
No, it's 80. But yeah.
$80 million to spend every year. No, that's more than my net worth. So there's a disclaimer here. Deal sourcing, yeah. So when I started to do this, I had no clue. But luckily, I had behind me an Indian Angel Network, and and by the way, I'm also an investor on the Let's Venture platform, and I do like to be a part of these platforms. And so they would bring deals, and it's just by nature of who I am that I started to become active in those deals because I like to get to know people. People is what I do. It's all about the team for me, right? And the problem. It also got me to read a lot. I came from a manufacturing background. I'm not from a tech background. But then I also was involved in building a university. And because of building the university, I was able to do a collaboration with IBM to actually help us build the software engineering, the engineering school. And when we did that, the exposure and the importance of technology. So in the beginning, I relied on networks, formal networks, to bring deals. And then for selfish reasons, I said, I want. So what I had a problem with is that there are some laws that exist within angel groups. And that is that the lead can only have a certain amount of stake, or and then there have to be so many investors, and then some of the investors are a little bit aggressive in wanting answers from you about how the company is doing, and I don't want to get phone calls at 4:00 in the morning, and so I started to do that less. But then I was working so closely with entrepreneurs that it started to spread. It spreads. Good news spreads. Bad news spreads faster. Right, so luckily, I guess a few more people said, "Okay, go and work with this guy." Then, guys said, "Stay away from this guy." And there are people who've said that. I told you there are some entrepreneurs that threatened with death. But deals, I get a lot of deals. I get a lot of deals. They just show up. I mean, sometimes I stop doing these events. I stop going. There's just deals and deals and deals. It's very interesting to remember. I said about 1,500 companies, maybe less, get funded, but I spoke about VC funding. There are thousands of companies that people set up in India every year. Thousands. Very few of them actually get an angel check. So the numbers are astounding. And only 1,400 or 1,500 make it to bigger investments, right? That again explains the risk to you. So founder diligence is more, background is very important because you're trying to figure out you know, what is it that, what is going to make them succeed? But I'm not that hooked on, which school or college, or are they from Stanford or MIT. There are some of those biases that exist in VC companies, or especially in multinational companies. So there's a lot of venture arms for multinational companies, and they'd like to perhaps back people that have spent a lot of money. I've not spent a lot of money in my education, so I don't believe in those biases. I've funded some people that are quite humble, and they've done really well for me. Customer diligence, I wouldn't have said it that way, but it's there. Is there somebody who's going to, what is a business? You've got a product or a service, and somebody has to buy it. Someone's got to show the money, right? So if you don't try to understand the size of the market, if the market is too small, there's one company that I'm working with right now that's positioned its product at the top end of a particular market, and they're having trouble raising money because everybody turns around and says the market is not big enough. A VC is looking to, look, there's very few companies that become unicorns, but that's what the VC wants. So if they don't see that this company can have a revenue of $100 million with a profitability within a certain amount of period, and that they can try to list it for $1 billion plus, they might not be interested in that company. But that doesn't mean that you won't get a good outcome. There's a company that I just exited. I invested the tiny sum of 15 lakhs into that company. At some stage, I sold half my stake for maybe 50 or 60. And so with the 7.5 lakhs that was left, I got a check of 3 crores. It's sweet. That's very nice. There was no VC funding after the first round of funding. Absolutely no VC funding. But they built a company. They were a terrific team, right? And I think that's a great return. I'm really happy with that, right? So again, one of the questions I ask is, how much money is it going to take to build out your company? That's very important. So if it's going to take billions of dollars to build it out, I shy away. So I shy away from consumer. Just because many of those companies take billions of dollars, or it's just become buy your customers. It's become a race to buy customers and grab land. And that doesn't work out for an angel investor. What you read in the paper isn't what's going to work for you, guys. You're in it to make a return. Choose your horses. And make sure that they're building a real business, and it's not going to take. But look at some very big companies like Make My Trip. I know from the inside, Naukri.com. These guys haven't raised billions of dollars, and they're very valuable companies. They're very large companies today, right? So try to understand what the life cycle of the company is. Market diligence is precisely that. And no, when I finish. Because this is for everyone. Sorry, guys. Setting realistic goals and defining targets is some of what I'm alluding to. You need to know the life cycle of that. You should be able to sit down and have that conversation with them. Where do you see this company in 2 years, or in 3 years, or in 5 years, or in 10 years? What are your ambitions? Are you building to sell, or are you building to list? There are clear advantages to listing a company, but not every company is listable. How many listed companies do we have in the entire, and how many of them are investable? When you go to a fund who's investing in listed companies, they'll tell you in India there's only 200 companies you can invest in. There may be 12,000 on the exchanges, but most of them are not doing stuff that you would want to invest in, right? So that's part of that. It's very common sense. What do you think?
Yeah, so I think the most important thing it comes down to is the passion. Because startup is a long succession of failures, hopefully followed by a success. But with most startups, it's just a long succession of failures, okay, followed by another failure, followed by another failure. So if you got an entrepreneur, and we invest in companies with co-founders because it's easier to do together than alone. But you're smacking your head against the wall, and there's like blood everywhere. And so which one's harder, your head or the wall? And so we invest in what we call cockroaches. and they're not particularly glamorous, and they're running around, and they get stepped on, and they might lose a leg or two, but they kind of get up and like keep on going, right? And so you got to just cockroach it out, right? And so the companies that are generally successful are the ones that don't give up. Resilience. Now, we've also had 3 suicides. So, and that's below market. So there's the other side where, sometimes it's time to like, throw in the towel or take a break, and we try and provide a lot of support for the companies that we work with. Okay, but the winners are the ones that generally do not give up or do not give up easily. They're so passionate about what they're doing that they'd be get like physically ill if they weren't chasing this. So we write the first check. And then we live together with the companies. And people who do this, they're crazy. Like who would to give away all the salary, burn up all their savings, never see their family, all for something that's never been done before and might not ever be done. Those people are kind of crazy. And then what we do, and the due diligence, is separating the crazy people from the batshit insane people. And so we double down on the crazy people, and we stay away from the psychopaths, because they are out there. There's some people that you do not want to follow on or be involved with. So,
just to add my 2 bits here. So, like all of us mentioned right in the beginning, it's a lot about relationship building here, and to ensure that the promoters see you as part of the company. So the due diligence actually helps a lot, because I think it's very important. I'm not sure whether, William will agree with me, but I don't think you do a detailed due diligence in the beginning, or legal and stuff, because...
we do a little bit.
Yeah.
But I mean, again, it's... So we do a fair bit, a little bit, but... not we don't like get out the gloves and go full proctology, okay? So so we we want to make sure that they're not lying to us, and we check them out a little bit. Background checks in Southeast Asia are not real, and anything. I mean, if the founder's going to screw you over, the founder's going to screw you over, and it's pretty hard to tell. But a couple of things we do. We always invest in companies with co-founders, but never more than 3. Just statistically, people who are single founders, that means that they can't convince somebody else to work with them. That's a bad thing, okay? And there's product, there's tech, and then there's selling stuff. And almost no one is good at all 3. So that's one thing. And then the other thing is we are coming in post-idea stage. So they already have a product. They already have, hopefully, some users. And, 60, 70% of the time, they already have revenue. So we diligence that as opposed to... and then we hang out a little bit with the founders. So our business model is don't be a jerk. You can choose to spend your life with people. So my goal in life is, not to spend time with, like, I don't know, the Travis Kavalniks of the world, or I don't even know how you say his name. But, I try not to spend time with, you're spending a lot of time with these people. So my goal is to spend time with people that, if possible, are not jerks.
Yeah, so, I have a friend who is a multi-billionaire. And he's got very successful companies in the US and in India. I'm not going to name him. And he told me once, he says when he hires people, he takes them to the golf course and plays golf with them. And then he cheats and then sees how they react, And then if they if they call him out, he's more inclined to hire them. But if they kind of praise him for cheating, then he's like, okay, you're not in. So a good way to do it with the startups, this is anecdotal, but guys, I like to laugh when I work. I'm not here to cry, right? And so also when I invest in startups, I'm not here to cry about the losers. So I go out drinking with them. I will drink, you know. I mean, I like to throw it back a little sometimes, not every day. I never drink alone. I'm not an alcoholic. But if you go out and socialize with them a little bit as well and get to know them as people, that's a lot of diligence. Yes, I use my accountants and my lawyers to vet the documents and to make sure that all the tax filings are done, all the proper paperwork is in place. But do I read it all? No. I call up my accountant and say, hey, did you take a look at it? And he goes, yes, and I'm good to go, right?
Yeah, there's a guy named Trump, because...
He hires the chiefs.
He cheats at golf every day.
He cheats at golf. So he's the one who takes all the guys that my friend doesn't hire.
So what I was trying to add here is, because, I mean...
By the way, now you and I can never go to America again. We're going to be on a hit list.
Yeah, you're on the blacklist now. You're done. No, so what I was trying to say there is, because, see, I mean, I'm not sure, as long as you use you do a proper diligence in the beginning, it'll help you set the company right in the beginning, because that's an essential step. I understand that you personally don't, would give it a lot of importance, but...
No, I do. I just, so my way of working is to get other people to do the work, right? So I'm just lucky that I have those resources now in place that I can call up someone and say, hey, did you do the legal stuff? And did you do the accounting stuff? And they have to say yes, because I'm going to go to them if something goes wrong, right?
Yeah. So because why I say this is, right in the beginning is an easy place to clean up the startup. You should ensure that the legal and everything is set right in the beginning, because that'll help your valuation also, because you're the lead investor. You're supposed to be mentoring the company. Ensure everything is done right for the company, and you prep them up for the next round, because then you become part of the company. I think that's very essential.
So we get a lot of companies that come in, and they're usually pretty bad at accounting. Maybe India is a little bit different, but so part of our program is we clean them up. We have a woman who's one of our EIRs, and we call her the cleaner. The movie like Pulp Fiction, like Mr. Wolf. So it's a person who comes in with the 2 duffel bags full of acid and makes all the dead bodies disappear. Okay, and we sometimes spend like months restructuring this stuff and trying to reconstruct the books and getting them ready for prime time. And that's part of the service that we provide, because it's her, and she's got a team of 27 accountants, and her job, the way she actually really makes money, is by working with VCs and doing due diligence into their potential investments for them. And she also does acting CFO, getting companies ready for IPO, like NASDAQ IPO, before they hire the shit-talking CFO to come in and actually do the IPO. So she's like the cleaner, right? So over time, you'll build these friends or assets or like resources, and we highly recommend. So they're your friends, and they've got your back, and hopefully. And then, like you said, you can point at them, hey, you screwed that thing up, so you better fix it for me now, please.
No, but again, the advantage of writing the first small check is that the companies that don't like to do paperwork and keep stuff clean and stuff like that, you don't double down on them, because they're never going to make it. You never know when somebody calls you to invest in the next round, right? People get discovered all the time. VCs are very smart. And so what is the next step? They want to do a due diligence, and they want a data room. And the more detailed people are, the more prepared they are, the faster it goes. Sometimes it takes a long time. We have to go a bit fast now. You did have a question. I'm sorry I interrupted. Would you like to ask it?
So you spoke about the consumer-based companies, right? They need more money to grow, they need more money to kind of be there. But there are also a lot of companies who have ventured the way in a B2B segment. For instance, Masho, if you look at it.
Yeah.
They first went B2B, and then the eventual vision of the company is to be a consumer company. But how do you distinguish between that? So
See, that was 10 years ago when they started. The world was very different. It's changing very fast. They've already established their brand, and really they needed less. In those days, you needed less money, right? I grew up at a time where an ice cream cost 15 paisa. It was very cheap. You don't get anything for that. So I think that consumer-based companies, as a thumb rule, I'm not saying everyone, there are some incredible companies in the gaming thing which are consumer-facing, and they've got like 300,000 downloads and 500,000 downloads just because there's bloggers, right, talking about it. But now the bloggers have started to charge a lot of money because they realize that they're bigger than Google, and they're bigger than some of the discovery platforms in doing what they're doing, right? So you have to figure it out. You have to figure it out. So sit down and have the conversation. It's like, how much money do you guys think? How many customers will you acquire with this, right? So one company told me, we'll raise our next round when we acquire 10,000 customers. But they don't have the money. They took 2 crores and it costs X amount of money, right? So I said, you have to bring it down and say, guys, we need to raise the next round when you have 1,000 customers. Can we do that? Is your concept proved, right? And so, yeah, that's really how you have to look at it.
So I'm going to go really quick here. We could do 2 hours on this, but we're not. So I'm just going to throw out a couple best practices, and if you want to chat later, happy to. So pricing the round, it's not so much science; it's more like art. The general rule of thumb is, as a founder, you probably don't want to give more than 15% away per round, and you're trying to keep over 50% of the company post Series A. But for investors, it might end up being like 20-25%. Generally speaking, you don't want to have more than 25% of the company go out per round. The pricing, it's all over the place. If you can get somewhere close to 100 to 150 times monthly net revenue, that's nice. In China, it's like 150 to 250 times monthly gross revenue, and you got to be careful about the revenue being fake. So it's it's a bit of a range, but the thing is a balance, right? So you got to remember that when you put your money in, if they hit their targets, and they go out to raise, and you take that their targets times 100 or 150 times net revenue, is that above or below what you're currently paying? Okay, so you want to put the company. You don't want the valuation to be too high, and you talked to the founder about this. You don't want to set yourself up for a down round. So if you hit your targets or you get close to your targets, and then you put a multiple on it a year out. You want there to be upside to it. You don't want to overpay. Actually, the founder should. The founders all get like, I want to raise at a super high valuation. It's not actually in their interest to do that because they're setting themselves up for killing their company. Down rounds oftentimes kill companies, even if the company is doing okay. This is just my experience. Terms for the round. Everybody's tries to become a private equity person. You're angels. I'm kind of like an angel. We want to basically not. So we want to have as few terms as possible. We want our basic protections so that this founder can't screw us over. We want to be able to invest again. And beyond that, you want to go kind of like Silicon Valley standard terms. Information rights, the right to invest again. There's one of the tools that the next guys use is a major shareholder. So give yourself major shareholder rights because that's bullshit. That's one way they try and take away your information rights. But beyond that, you don't want to give yourself a veto on anything because that'll mean that every single person down the road will have a veto. And when you're at Series B, having a democracy is not a good idea. That's not even a democracy. Democracy is fine. Everybody having a veto is just a very bad idea, and it's very bad for you. Yes, you need to support the founders. Sometimes it's like daily calls, okay? It's a lot of work, so go in with eyes wide open. And due diligence report, the goal is to have one, okay? You're going to get standard questions asked. You might be able to come up with your contracts in a day, but you're not going to be able to come up with a financial model in a day. So prepare it ahead of time. Negotiation, I mean, try and hit industry standard. Okay, and it's not industry standard from the VC side, and sort of industry standard from, if possible, Silicon Valley side. But try and keep within the standard, and push back on anything that's not standard. Standard VC is to see whether you're stupid or not. What do? They send you a term sheet, which is full of stuff that's very, very bad for you and for the founders, and they use it as a test to see whether you know what you're doing. If you push back, actually they will give it all up because they know it's completely freaking unreasonable. But they're just doing it to test you to see whether you're like the founders got their shit together, or the founder plus you's got their shit together. So
it's like when you go to a OT and the doctors really laugh about the patient that's on the table just to make it more doable. The VCs also laugh about people at the back of it. But, on the pricing around, so what I do is I tell the founders, what is it? Tell me the price. And my straight answer, if I think it's overvalued, is thank you so much. I'm not going to do it. Now, I had a guy recently who valued no revenue. He's got one order. He doesn't have the money to fulfill it. He wants a loan to start. And then he's saying, I want to price my company at 50 crores, pre-money. So I said no. And then the next day he came back and said, so how about 20? How about 20 crores? Can we, Now, that's not a guy who's investable. So please ask them to come to you with a valuation expectation. Sit down and do the numbers about how much money. Talk to them about it being a win-win, and find a healthy place that you feel comfortable. Sometimes if you've got mature founders who are already making a lot of money and they're not going to take a salary from the company for a year or until Series A is raised, it's reasonable to give them equity in lieu of the work that they put in, especially if it's a really seasoned team. But if it's a young bunch of kids who already sleeping on a mat on the floor, for heaven's sake, and they come and tell you, my company's valued at $10 million, don't fall for it. So work. It's quite logical, right?
And the other thing is, in the past, like in the Valley, there's a VC round. So there's the angels, and then a VC comes in and takes as much of the round as possible. They lead the round, they set the terms, they take a board seat, and they're kind of like committed to the company. And if things go bad, they usually are supposed to step up and help the company. Nobody steps up anymore. It's like, oh, it's going badly, see you later. And also, it's venture capital. It's more capital. There's not a whole lot of venture going on. Okay, we got this thing called like party round, where it's you and like he does it a lot. So and a group of friends, and they come together and they trust each other and they worked together before, and there's really a sense of trust, and they go in together, and maybe they're all writing 25K checks, or maybe they're for these early stage VCs, they're writing 200-300K checks, and they're coming together and they're working together. And so party round used to be a bad word. Now it's almost like a fact of life, and it spreads the risk. It also spreads the work, and it used to be looked down upon, because people said, okay, no one has responsibility and no one will step up when things go bad because it's a party round, right? Well, what happened is the lead VCs, if you look at like Sequoia or whatever, what happens is, they spend 80% of their time on the 20% of the companies that are doing well. And if you actually interview the other companies, they're like crickets. I need help. Crickets. Like there's little bugs. They don't hear anything back. So the reasons why party rounds are looked down upon have kind of gone away. Having if you get a good syndicate together, a group of people together to come and back you, and that's you guys, then you can actually do reasonably well, pretty well. The one thing I would note is that when the VC comes in, you guys all have to stick together, because if you stand one by one, the VC will divide and conquer. and you'll lose all your rights, you'll lose your information, you'll lose everything, and the next thing you know, they increase the ESOP by 40% and you're gone, okay? So you need to all try and get to know each other and help each other and band together.
And that's why platform investing is a good idea for people who are starting out in this, because it really helps you to get, you know, your syndicate going or your bunch of people. It's not always your brother-in-law that'll invest with you. It could be somebody else. It could be someone in the room that can provide a huge amount of value. If you're going to play this game, it's your job to know those people, right?
I mean, I don't have much to add because they've covered everything. This is all commercials.
This is yours.
No, because I covered the diligence part already. So the diligence is, and like William mentioned, one thing you'll have. This is a slide, right? Yeah. One thing you'll have to keep in mind is when the VC sends a term sheet, it is always negotiable. Please, I mean, even if you require the funds and it is necessary for the company to survive, you can always negotiate. There is nothing like it is I mean, they just send you a standard draft, which will have very unreasonable terms. It can always be negotiated. And maybe they're testing grounds or they're trying their luck.
Yep.
So that always works.
Except for me. Actually, we use standard docs, and they're generally on our website, and they're really quite friendly, and they don't generally change. But for VCs, yes, definitely negotiable. Oh, and the last tip is instead of waiting for them to send you a term sheet, you send your term sheet to them. You know, there's usually not a problem with it. You send it to them blank, and they can fill it in. But yeah.
Yeah, I mean, actually, that's a very good tip because I've seen startups. I mean, I've seen angels start doing that because generally what happens is a company in the beginning would not have much legal support. They'll be like, okay, there's a VC, let's push the work onto them. They will send the term sheet. We just have to review it. You think you're making it easier for you, but you are not making it easier for you because you will be you're setting the benchmark to negotiate. I mean, to start at the negotiations at. I think you should set that benchmark. So you send the term sheet.
I have a trick there. So I recently did a deal where two VCs came in at the same time as the angels, right? And I was like a run for, and so I said, all right, guys, you do the term sheet, but all three will give me written statements that the rights for everyone are exactly the same. Everybody laughed about it, but they did it, you know, and that's fine for me.
Because there's, I mean, the documents, I mean, we've already covered that generally. So as long as you have the basic protections, because I think the whole idea is angels have to understand that you are an angel investor. The idea is to grow with the company, not restrict the company. And it's always a plus one. The rights you take now, the VC would come, they would take the same rights and add on to that. So you would like to avoid that.
Guys, we have 4 minutes left. And we haven't done Q&A properly, so sorry, guys.
Yeah, we don't really need to talk about this too much.
I don't take a board seat.
Don't take a board seat. I don't take board seats
rights,
either.
Basic rights. Very basic, you know, next round investment and information rights.
I mean, reporting is quite simple. The biggest clue that a company is dead or dying is they stop reporting. So just explain this to the entrepreneur and say, even if things are crap, you still want to report. Because when things get better, then you get credit for it. Okay, so future investors invest in a time series, not in a slot in time. So if things are bad and then things get better, then you can fundraise off of it. If things are bad and then they get better, and then you start reporting only when things are better, you don't get credit for the upswing. So it's a little bit of you're going to have to do your work to try and get the entrepreneur to continue to report. Sometimes we actually do it for them, but I don't recommend it because it's not scalable. But reporting, and then. The other thing is the entrepreneur should never ever lie, okay? Bad. But they can tell the best truth, okay? You should never ever ever lie, and you might not want to tell the best truth. You might want to tell a balanced truth, okay? You know, like there's good parts and there's bad parts because all you have is your reputation. It might not seem like a very small world right now, but we keep lists of the VCs and angels and what we think about them. These lists sometimes get shared more than or they're supposed to, but it's a very small world.
It's a tiny world. It's a very small. And your reputation is the only thing. You won't take the cash with you. You might take your reputation with you. Unless somebody has a question on that slide. Does anyone have a question on that slide since we're showing?
Yeah, that's one thing I completely agree with. I think you should have the right to have a board seat, just for safety's sake. But I get it. The whole idea with what Sunil and William are trying to say is that you should give them the freedom to run the company as it is. Don't control the company too much. The whole idea is you have a stake. The company grows, you grow. Why do you need to control the company?
You don't own the company, right? The entrepreneur owns the company. Let him own the company, right? So board seat also carries some liability. So there's other formats. There's observer seat. There's, but the way I do it is relationship. And, I spend enough time with them and they tell you everything, right? But there are observer, we've discussed observer.
So you just get access to everything. I would still recommend at least have a right to take a board seat.
If you take a board seat, take a non-executive director board seat.
You would be non-executive, maybe because you won't be on the road.
Yeah, but there's like legal liability. Self-explanatory.
Yeah, helping plan the fundraisers, you've really got to do the exercise of how much money they need. Because sometimes people will throw more money to them than they need. And a good founder doesn't take it, so he will, because he doesn't want to get diluted beyond a point. But VCs have a point too. Look, if they don't perform, they die, right? The LPs are pretty harsh with them sometimes. And there are many VCs shut down because they didn't perform. So how much money is needed to go the next, what are the metrics? And what really happens after the initial startup funding is that the cycles are between, around 18 months. And the company should go to the market to raise more money in 12 months if they're going according to plan, right? Because it does take 6 months to start to close some of the bigger rounds, between the diligence, between the dating all the VCs, and then between, getting the paperwork closed and the diligence done and the check in the bank. So 12 months, they should have enough money for 18 months is kind of what the cycle that we've seen globally as well, right? Yeah, sometimes you need a bridge because that the VC round is coming. There's one I'm participating in right now. They've signed the term sheet, diligence has started, and they need some money just to be able to sustain for the next format. It's not good planning. So whoever the angel was didn't help them a lot in that, but yes, I'm going to participate in that round, right? Making intros to potential. So, I avoid that. I don't really like to call VCs and say, hey, me. But yes, there are times when I will, meet them socially, talk to them about it. But I want the founders to be able to understand because they need to, it's their company, right? They need to know. And trust me, it all starts falling into place because the best company, the VCs want to invest in the best companies. And if the company is doing well, people will approach them. They have an army of people that are actually spying on everything. It's kind of like we said, we can't go to America anymore because of what we said. We can't repeat it. I mean, it's really like that. You are being watched. There is Big Brother. Negotiating the rights of the syndicate, that's just exercising the rights that you want to have, right? We're human beings. In fact, we did the hard work. So I don't want to be screwed on that. Pro rata for leading for exit. I think exit is like a long way away. Somebody else actually takes the lead on that. I've never really been a part of an exit. I just get the check and say thank you very much. But there haven't been that many. But yes, creating a plan, you need to do that.
And if the founder screws up and is in an acqui-hire situation and lost your money and then feels bad, hopefully. This is not the time to get angry and throw a tantrum. This is the time to be supportive and say, yeah, shit happened. We made mistakes, and that's life. That's startup, and we might get like 20 cents back on the dollar or nothing, but it's an acqui-hire situation. And this is where this is actually a really good PR period for them. It's like, yeah, you learned a lot. We learned a lot. If you do another startup, we'll back you again. And you know what those people are called? They're called serial entrepreneurs, which you generally want to invest in. So that's where there's no upside from getting angry, but there is upside from being supportive. And so, our business model is don't be a jerk, and this is one of those times when it really pays off. Plus, they're going into an acquirer, which could be like a good set of relationships for you, right? Hopefully.
Yeah, I mean, we said we've talked about most of this, but yeah, you need to be able to invest money on, yes, if you have domain experience, it's like if you've so a lot of people came to me in the education vertical because of the university background, right? And so people wanted to get me to invest in their companies on that. But if you've got domain experience, and many of you are tech guys, and many of you are very, obviously you have the money to invest, and therefore you've seen enough success, then if you like, your area and you see the gaps, that's a good place to invest in. Ability to play coach and mentor to the founder, we've talked about it, I think, enough, right?
Yeah, I mean, mentors are not people that tell entrepreneurs what to do. They're people that share their experience, and their, what they've seen happen, and then help the entrepreneur kind of get to where they're going and discover for themselves. Again, it's not your company. If you want to do a company, go do a company.
Yeah, exactly. No, so I'll give you an example from this morning, right? So there's one team that I'm invested in, and I've told them this story, so you guys can plug your ears for a couple of minutes. But so these guys are two really smart techies, and the whole world is their computer, and they have nothing. They are not aware of anything in their ecosystem. I don't know why that happens with people who are into technology that deep, but they become kind of isolated. So then they realized, and we kept telling them that, guys, you're building a fantastic product, but you got to sell the product, and you don't know how to sell the product, and your market is the United States. So they onboarded a guy who's going to head sales. And then the guy who's going to head sales wanted to hire a guy. And they're like, well, we want to interview the guy. So I'm like, what are you guys doing? I mean, it's not your job, right? So you have to be able to give up control. These are the kind of things I sit and work with them on. And the fact is that if you build that trust and that relationship, they will listen to you. But, it's like sometimes your parents will tell you something that you don't want to listen to. At least I remember from my childhood. And my mother, who's 80, God bless her, she's, fitter than I am. She still reminds me of those incidents. You don't want to listen, but you'll listen to your friends. They might be saying the same thing, right? So become that friend. Become that person that the entrepreneur will definitely go to in times of darkness, because you don't want them to lie to you, right? So if they trust you, they will come to you and discuss these issues and practical knowledge and your experience. You're all experienced people. Yeah, we covered this, right?
So we don't actually take carry for leading, but I'm not against it. You just have to, we talked about it a little bit before, but if you're getting paid to do a job, you need to do the job. And the funny thing about getting paid to do a job, and what we did with our platform, is you could get fired if you don't do the job. And that generally kept people on their toes, because we could take the carry away. And remember, you're not going to make any money on this. Okay, so you're getting 5% or 10% or whatever, and you're putting in tons of hours for the next 8 to 12 years. So if you think about what your carry is going to be worth for most of the deals, at the end of it, you'll either be able to buy yourself a very, very nice dinner or a very, very small car. Okay? So you're doing this not for the money. You're doing this to learn, to get something personally out of it. Or sometimes you're actually doing it because you can do a syndicate, and with a group of people, you can defend yourself better against the VCs. But you're not doing it for the carry.
Totally agree. I've not done it for the carry, and it's been pretty good, right? And one more thing that you could potentially get is that if you do a good job of being a lead, then Shanti will catch you and make you sit on the stage next year. Yeah, you can get that.